Why do intelligent professionals in America work harder than ever, earn six-figure incomes, follow every financial headline, and still remain financially average? Why do some generations remain steady during market collapses while others panic at a 15% drop in the S&P 500? Da Vinci understood something modern investors ignore. Intelligence does not create advantage. Structure does. And when structure is misaligned, even brilliance compounds into mediocrity. Gen X's financial behavior did not emerge randomly. It was engineered by inflation shocks, market crashes, corporate downsizing, and repeated exposure to contraction. Environment shaped reflex, reflex shaped allocation, allocation shaped compounding. And here is the uncomfortable truth. Most people today are optimizing effort, not architecture. They are informed, ambitious, analytical, yet structurally fragile. And the mistake behind that fragility is not what you think. Money does not primarily reward intelligence. A few years ago, I revisited an idea from Morgan Housel's work on money psychology. He argued that financial success is less about what you know and more about how you behave. That statement sounds simple. It is not. Knowledge expands, income increases, access to information multiplies, but behavior under pressure rarely evolves at the same speed. When markets drop, when inflation rises, when the Federal Reserve shifts policy, intelligence does not automatically translate into stability. Reaction reveals architecture. That realization led me to define something deeper: the behavioral wealth divide. If behavior determines compounding, then environment determines behavior. And if environment shapes behavior, then generational exposure becomes structural. So the real question is not who studied finance more, it is this: what shaped Gen X's financial reflex differently from others? In our last discussion, we exposed the psychological patterns that quietly shape financial outcomes and reinforce predictability. Today, we move deeper. We confront something more uncomfortable: the possibility that intelligence itself can become a ceiling. Predictability is not born from laziness or lack of ambition. It is engineered through structural conditioning, repeated exposure, and unexamined reflexes that feel rational but quietly limit expansion. Gen X did not simply choose different financial habits. Their economic environment shaped their reflexes before their careers fully formed. They entered adulthood during contraction, not expansion. They experienced inflation volatility, equity collapses, corporate layoffs, and housing instability before confidence solidified. Those experiences calibrated emotional thresholds around risk. Later generations matured in an era of stimulus, digital acceleration, and prolonged asset inflation. Growth felt continuous, liquidity felt permanent. Different baselines produce different stress responses. And stress responses determine positioning during volatility. So if behavior divides outcomes and environment shapes behavior, then structural difference becomes inevitable. The divide is environmental before it is generational. If you prefer strategic architecture over financial noise, subscribe. This channel is not built on hype, trends, or motivational shortcuts. It exists to dissect structure, how money moves, how behavior compounds, and how positioning determines outcomes long before results appear visible. Most financial content teaches tactics, very little teaches calibration. Calibration under pressure is what separates temporary success from durable expansion. If clarity matters more to you than stimulation, remain here, because what follows is not about inspiration, it is about alignment, and alignment requires precision. Now, return to the core question. What specific economic exposures shaped Gen X's financial reflex differently from other cohorts? To answer that, we must examine volatility, inflation cycles, asset bubbles, and corporate instability not as events, but as behavioral sculptors. The structural mistake most generations make is assuming wealth is a function of intelligence or access. It is not. It is a function of behavioral calibration under pressure. The US stock market does not reward brilliance. The S&P 500 does not reward prediction. Corporate America does not promote the most analytical mind. It advances the most stable operator. When inflation rises or interest rates adjust, those calibrated to volatility remain positioned. Those conditioned by expansion hesitate. Gen X's early financial years were marked by disruption. The dot-com crash erased confidence in unstoppable technology. The 2008 crisis shattered assumptions about housing permanence. Federal Reserve shifts redefined borrowing cost and leverage risk. These events did more than reduce portfolios. They altered reflex. And reflex, not intelligence, determines whether capital compounds or retreats. Consider two professionals in the United States. Both earn $120,000 annually in corporate America. Both follow financial news. Both contribute to retirement accounts. The first began investing in the early 2000s. He experienced the dot-com crash. He watched technology stocks collapse and saw colleagues lose half their 401k. He entered the workforce knowing markets fall hard. The second began investing after 2015, during prolonged asset expansion fueled by stimulus and low interest rates. Her reference point is steady growth. When the US stock market declines 15%, she feels destabilized. One interprets volatility as routine. The other interprets it as warning. Intelligence is equal, income is equal, information access is equal. But calibration is different, and calibration determines whether exposure continues or pauses when uncertainty rises. Financial intelligence without emotional control becomes volatility. Access to more data, more Wall Street analysis, more economic forecasts does not automatically produce stronger outcomes. In many cases, it amplifies reactivity. During the 2008 financial crisis, highly educated professionals exited positions near the bottom, not because they lacked information, but because their emotional threshold collapsed. Information did not fail them, calibration did. Have you ever sold an asset not because your thesis changed, but because discomfort intensified? Have you mistaken anxiety for insight? Gen X's formative financial years included collapse before confidence solidified. That early exposure reshaped loss perception. Temporary drawdowns became expected phases, not existential threats. Stability in behavior replaced certainty in prediction. And stability, not prediction, is what markets quietly reward over decades. Volatility is processed emotionally before it is processed rationally. Scarcity memory imprints differently depending on timing. Those who witnessed portfolio collapse early in adulthood developed defensive reflexes, but also resilience. They learned recovery follows contraction. Those whose early financial years occurred during uninterrupted expansion internalized a different baseline. Growth felt normal, liquidity felt permanent, contraction felt abnormal. Baseline expectations shape stress response shapes allocation behavior shapes compounding. Loss aversion intensifies this divide. Humans feel losses more strongly than equivalent gains, but repeated exposure reduces shock. Gen X recalibrated loss perception through repetition. Drawdowns became tuition, not betrayal. Without recalibration, individuals exit prematurely and re-enter cautiously, fragmenting growth. Emotional detachment increases consistency. Consistency compounds. Ego does not. During the Renaissance, Florentine merchants expanded trade across unstable territories, while cautious scholars anchored themselves to predictable patronage. The merchants accepted uncertainty in exchange for scale. The scholars preserved intellectual purity but remained structurally limited. Da Vinci observed these systems closely. He aligned himself with patrons who controlled commerce, capital, and political leverage rather than institutions focused solely on theory. Exposure built advantage, stability preserved comfort. The difference was not intelligence. It was positioning inside dynamic systems. Modern markets operate the same way. Corporate salary provides security. Market ownership provides leverage. Avoiding volatility protects emotional comfort. Structured exposure builds compounding. Gen X internalized instability as normal early in adulthood. That normalization altered financial reflex. When contraction arrived, it confirmed expectation instead of shattering it. Behavioral calibration can be measured. When the US stock market drops 15%, do you increase allocation or pause contributions? When headlines predict recession, do you consume more financial media or revisit your predefined plan? Structure reveals itself in repetition. Wealth compounds through consistent exposure under defined risk parameters, not through reactive timing. Gen X investors who endured previous cycles often gravitated toward diversified ownership, such as the S&P 500, because they recognized the limits of prediction. Humility stabilized participation. Participation enabled compounding. Younger investors frequently attempt precision, entering and exiting based on perceived signals. Precision feels intelligent. Consistency feels boring. But markets reward boring discipline more than dramatic forecasting. Ask yourself, are you optimizing for being correct or for remaining positioned long enough for compounding to work? If this level of structural analysis sharpens your thinking, remain connected. This channel is built for those who value calibration over stimulation. Markets do not reward excitement. They reward alignment. Most financial conversations revolve around tactics, trends, and temporary signals. Few examine architecture. Architecture determines durability. If you are interested in dissecting systems rather than chasing sentiment, subscribe. Precision compounds quietly. Now return to the central divide. Gen X's financial reflex was shaped not only by equity crashes, but also by debt perception. Interest rates in the 1980s and 1990s were materially higher than the ultra-low borrowing environment that followed the 2008 crisis. That contrast influenced leverage behavior in ways many underestimate. Exposure under expensive capital builds caution. Exposure under cheap capital builds confidence. The dot-com crash left a psychological imprint that still influences behavior. In the late 1990s, technology stocks appeared unstoppable. Valuations detached from cash flow. Optimism overshadowed discipline. Then contraction arrived. Companies collapsed. Portfolios evaporated. For Gen X professionals in corporate America, the lesson was immediate. Hype decays, earnings matter, leverage without foundation implodes. That imprint reshaped allocation logic. Growth narratives were no longer accepted without structural support. Younger investors who matured after prolonged expansion experienced technology dominance differently. Digital platforms scaled rapidly. Venture capital flowed freely. Equity valuations expanded for years. Baseline expectations formed around acceleration, not collapse. When correction arrives, shock differs. One generation expects contraction within innovation cycles. The other perceives disruption as anomaly. Memory alters tolerance. Tolerance alters positioning. Positioning alters compounding. The 2008 financial crisis reinforced a second structural lesson. Systemic shocks are not theoretical, they are cyclical. Suburban real estate values declined sharply. Retirement accounts contracted. Corporate layoffs accelerated. Credit tightened. For many Gen X professionals, this was the second major collapse within a decade. Repetition reshaped perception. Market downturns were no longer rare anomalies. They were embedded features of economic cycles. That repetition reduced panic threshold. It normalized contraction. Younger cohorts who entered the workforce after the crisis experienced the recovery phase first. Asset prices rose steadily. Monetary policy remained supportive. Liquidity expanded. Stability felt restored. Baseline expectations diverged again. Those conditioned by repeated downturns remained cautious but persistent. Those conditioned by recovery interpreted growth as default. Default assumptions shape allocation discipline during stress. Identity quietly interferes with compounding. Many intelligent professionals in America equate financial competence with predictive accuracy. Being right feels validating. Being wrong feels destabilizing. During volatility, exiting positions can feel like reclaiming control rather than reacting to discomfort. But markets do not reward ego preservation. They reward disciplined exposure under defined parameters. Gen X investors who endured repeated downturns learned a humbling lesson early. Prediction is unreliable. Participation is durable. That humility detached identity from short-term outcomes. Younger investors, raised in an era of constant financial commentary and digital feedback loops, often tie self-image to performance cycles. When portfolios fluctuate, identity fluctuates. Emotional turbulence increases trading frequency. Trading frequency increases friction. Friction erodes compounding. Ask yourself honestly, are your financial decisions protecting capital or protecting ego? Silicon Valley offers a modern illustration of structural calibration. Founders who endured the dot-com collapse often built later companies with disciplined capital management, controlled burn rates, and sustainable margins. They had witnessed overextension. They had experienced contraction. Their risk models incorporated failure probability. In contrast, founders who emerged during prolonged liquidity expansion frequently optimized for rapid scale, supported by inexpensive capital. Growth was prioritized over durability. When monetary tightening arrived, fragility surfaced quickly. The difference was not creativity, it was exposure history. Environmental pressure reshaped leverage tolerance. The same pattern applies to individual investors. Those conditioned by contraction build buffers. Those conditioned by expansion build momentum. Momentum thrives during growth. Buffers endure during stress. Which architecture defines your financial life today? Gen X's financial behavior is not inherently superior. It is structurally different. It reflects adaptation to inflation spikes, asset bubbles, credit contractions, and repeated market resets. Millennials and younger generations face different pressures. Digital acceleration, remote work volatility, cryptocurrency cycles, and unprecedented monetary intervention. Each environment produces its own behavioral imprint. The divide is not moral, it is environmental. Environment shapes baseline expectations. Baseline expectations shape stress response. Stress response shapes allocation discipline. Allocation discipline shapes compounding. The behavioral wealth divide therefore extends beyond age. It asks a sharper question. Were you conditioned by contraction or by expansion? And more importantly, have you recalibrated intentionally, or are you operating on inherited reflex? Reflex without awareness compounds blindly. Awareness allows redesign. The real test of financial architecture is not expansion, it is contraction. Imagine the next recession unfolds gradually. Corporate America slows hiring, bonuses shrink, layoffs increase quietly. The US stock market declines 20% over several quarters. Suburban real estate stagnates. Interest rates remain elevated as the Federal Reserve prioritizes inflation control. Nothing dramatic, just sustained pressure. Now observe your reflex. Do you reduce 401k contributions because headlines feel heavy? Do you pause allocations waiting for clarity? Do you increase cash beyond rational necessity because uncertainty feels threatening? Or do you continue structured exposure because volatility was already anticipated in your design? The future will not introduce new psychology. It will expose existing conditioning. Exposure under stress reveals calibration. When contraction persists, emotional fatigue increases. News cycles amplify uncertainty. Analysts debate recession probabilities. Colleagues discuss portfolio losses. In these environments, behavior fractures. Some increase information intake, mistaking analysis for control. Others disengage entirely, preferring distance over discomfort. Both reactions signal fragility. Gen X investors who endured repeated downturns often internalized a different rhythm. Volatility rises, volatility falls, cycles repeat. That rhythm reduces urgency. Reduced urgency preserves exposure. Preserved exposure compounds. Stress does not create structure, it reveals it. Ask yourself directly, during extended uncertainty, do you abandon discipline or deepen it? Do you seek reassurance or rely on predefined allocation rules? Your answer defines your architecture more clearly than any spreadsheet or degree. Calibration is not inherited permanently. It can be engineered deliberately. You do not need to experience economic collapse personally to build contraction tolerance. You can simulate stress through disciplined exposure. Define acceptable downside before entering markets. Predetermine allocation percentages during volatility. Limit emotional decision windows. Replace reactive timing with structured repetition. Conditioning shifts when behavior repeats under defined boundaries. Gen X developed resilience through forced exposure. You can develop it through intentional design. The goal is not fearlessness. It is measured response. Measured response reduces fragmentation. Fragmentation destroys compounding. Ask yourself, have you built rules that operate when emotions rise? Or are you negotiating with uncertainty each time it appears? Architecture eliminates negotiation. There is another structural divide rarely discussed: income dependence versus asset positioning. Many intelligent professionals in corporate America optimize salary growth but neglect ownership expansion. Salary provides stability, ownership builds leverage. Gen X professionals who witnessed layoffs during the dot-com crash and the 2008 crisis learned that income can disappear quickly. That lesson shifted focus toward equity participation, diversified investments, and long-term asset accumulation. Younger professionals raised in prolonged hiring expansions often anchor identity to career trajectory alone. When corporate stability weakens, fragility appears. Income is linear, ownership is exponential, salary depends on institutional approval, assets operate independently. Which structure governs your financial life today? If income stopped temporarily, would compounding continue? Structural resilience is not measured by paycheck size, it is measured by ownership depth. There is another structural divide rarely discussed: income dependence versus asset positioning. Many intelligent professionals in corporate America optimize salary growth but neglect ownership expansion. Salary provides stability. Ownership builds leverage. Gen X professionals who witnessed layoffs during the dot-com crash and the 2008 crisis learned that income can disappear quickly. That lesson shifted focus toward equity participation, diversified investments, and long-term asset accumulation. Younger professionals raised in prolonged hiring expansions often anchor identity to career trajectory alone. When corporate stability weakens, fragility appears. Income is linear. Ownership is exponential. Salary depends on institutional approval. Assets operate independently. Which structure governs your financial life today? If income stopped temporarily, would compounding continue? Structural resilience is not measured by paycheck size. It is measured by ownership depth. Another silent divider is consumption architecture. Expansion cycles normalize lifestyle inflation. Rising income fuels rising expenditure. Suburban homes scale. Vehicles upgrade. Travel increases. Consumption becomes identity reinforcement. Gen X, conditioned by instability, often maintained moderated expansion despite income growth. Not universally, but structurally more frequently. They witnessed asset collapse. That memory tempered visible consumption. Younger generations raised in digital comparison environments experience constant exposure to curated success. Visibility pressures spending. Spending reduces surplus. Surplus fuels ownership. Ownership compounds. Consumption depreciates. The behavioral wealth divide widens not only through market reaction, but through allocation of surplus capital. Are you directing incremental income toward equity or toward image? Markets reward invisible ownership more than visible lifestyle. Compounding favors those who delay gratification without broadcasting restraint. This channel is not built on hype or financial shortcuts. It exists to study principles, decisions, and structural clarity. I do not lead with tools, and I do not sell urgency. Understanding always precedes execution. But when wealth transitions from theory to reality, structure becomes unavoidable. Without defined systems, even disciplined decisions erode over time. I use a simple framework personally to maintain clarity, allocation discipline, and ownership focus. No subscriptions, no noise, no dependency on constant signals. A single intentional structure designed for autonomy rather than convenience. It exists for those who value calibration over stimulation. The link is below. Clarity always comes first. Structure follows. Gen X's financial behavior is structurally different because environment sculpted reflex. Inflation cycles, the dot-com collapse, the 2008 crisis, and shifting Federal Reserve policy recalibrated emotional thresholds early. Repetition reduced shock. Reduced shock preserved positioning. Preserved positioning compounded. The behavioral wealth divide is not about intelligence, income, or generational superiority. It is about calibration under uncertainty. You do not earn wealth through effort alone. You expose your structure through repeated decisions under stress. Da Vinci understood that mastery requires alignment between internal architecture and external systems. Talent without positioning stagnates. Positioning within dynamic systems expands. Money does not reward intention. Money reveals design. Examine your reflex, examine your exposure, examine your ownership. Because compounding does not negotiate with emotion, it compounds with structure. This was why Gen X's financial behavior is structurally different. We examined how environment shapes reflex, how volatility calibrates tolerance, and how structure, not intelligence, determines compounding. Effort alone remains capped. Information alone fragments. Calibration under pressure separates durability from fragility. The behavioral wealth divide is not theoretical. It is observable in allocation, leverage, and ownership decisions repeated over decades. This is not the end of the discussion, it is the foundation. In the next analysis, we will go deeper into how these structural principles translate into practical positioning inside modern American markets. Precision compounds when applied consistently. If this breakdown sharpened your thinking, continue with the next video. It will take you further. Support the channel by liking, sharing, and subscribing, and leave your thoughts in the comments. Stay sharp, stay intentional. Keep shaping your wealth the way Da Vinci shaped his work, patiently, deliberately, and with an understanding of the rules that govern results. Thank you for investing your attention here. Continue examining your architecture. I will see you in the next video.